Hello again, welcome to another episode of the Uranium Market Minute. Today is Friday, February 11th, and this is episode number 76. My name is Justin Hune. I am your host. I'm the founder and publisher of the Uranium Insider Pro newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Thank you again for tuning in. Before we get into today's content, nothing in this video is intended to be investing advice. I'm not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing, and always take responsibility for your own choices. All right, really appreciate you all being here. It's been a short week for me in terms of doing the podcast. I've been out for the last 3 days on a due diligence trip, doing some boots on the ground, visiting one of our focus list holding companies, doing site tours, etc. And of course, things have been busy in the uranium market. We've been putting out and structuring and putting out a new options trade, which if you are a member, you should have received that bulletin on Wednesday. That trade is still valid, by the way. But yeah, quite an exciting week. I'm going to talk about the Cameco conference call in the mailbag section today. Before we get into that though, let's go right into the daily scoreboard and check out the numbers regarding the spot price and the flows into the physical trust and the ETFs. Spot market today up a little bit, up about 50 cents to $43 a pound mid-market from the low of this week. So that's we're starting to see some firming up of the spot market. We had huge volumes in the spot market in terms of pounds traded back in January. Things have slowed down a little bit in terms of that volume. However, the spot price is firming up and starting to move up again. We've seen Sprott come into the market a bit. In fact, they have purchased, and so all these numbers I'm going to give you in terms of the Sprott purchasing and money raised and the ETF flows is for the last 3 days, Tuesday, Wednesday, and Thursday of this week. For the last 3 days, the Sprott Physical Uranium Trust has raised 43 million in new capital. They purchased 700,000 more pounds of U3O8. That makes the year-to-date total 3.7 million pounds and 199.5 million in new capital raised. So annualizing those numbers, which you shouldn't, but you never know what direction these markets are going to go in. But we're over, this is over 30 million pounds for the year if they continue at this rate. And I believe that they will, not necessarily in a steady fashion, but overall on balance for the end of the year. In fact, I think we're going much higher than that, in my personal opinion. The past 6 weeks or so since the start of the year, most of that time, the Sprott Physical Uranium Trust has been trading at a discount to NAV. So they have taken advantage of the few days. In fact, there's probably less than 10 days over the past 6 weeks that they've been at a premium to NAV, and probably even less than that at a significant enough premium to NAV to raise capital. They did take advantage of that one big day in January on the Kazakhstan news when they saw record volumes. I believe, if I recall correctly, they raised north of $80 million that one day. So the bulk of the raise this year, well, not the bulk of it, actually, about a third of it came in a single day. So they are Johnny on the spot when it comes to reacting to the market sentiment turning green. And when they see volumes come in, when they're greater than the 1% premium to their net asset value, they are definitely taking advantage of that moment and raising money, considering they've raised $200 million in the past 6 weeks. 3.7 million pounds, like I said, this is big. They are continuing to just chomp away at that above ground supply. We believe that is getting quite thin. Of course, there is consistent production that comes into the spot market. And as I've talked about many times before, we have this unwind of the carry trade, which is pounds being held by traders to deliver into future contracts. Those pounds are being sold in the spot market because we have a slight backwardation in terms of the spot price being higher than the midterm price. These traders are able to sell at a spot price and then secure those pounds out 2, 3, 4 years down the road prior to their delivery commitment at a lower rate, not necessarily always at a lower price, but sometimes we'll have lower rates, lower cost of carry, etc. There's a number of factors that go into that calculation that justifies that unwind of the carry trade. That's something that's been providing some short-term volume and liquidity into the spot market. However, those pounds are being purchased from the future. We're setting up a situation in which the backwardation in the spot market relative to the forward curve is going to draw out some of those pounds held in carry, perhaps maybe even a majority of those pounds held in carry. How much exactly? Well, nobody ever really exactly knows. What some estimates we've seen, one of the top industry analysts and folks that work in the nuclear industry, his name is Dustin Garrow. He's very sharp. He's very experienced in this industry. He believes there's about 8 to 10 million pounds held in carry that could shake out in this unwind. Then we have folks like Art Hyde from Segra Capital, who believes it's considerably higher, probably north of 30 million pounds. How much of that can actually shake out? Not all of it. That obviously depends on the time frames for the pounds held and carry. You could have pounds held and carry that are needing to be delivered in a matter of months, and doing this type of trade with that short time frame might not make any sense. Either way, short-term liquidity into the spot market will likely keep us from seeing a huge run in the spot price between now and when those pounds are cleared out. So we have this situation where those pounds need to be chewed through before we get to a market where there is very little, if any, buffer whatsoever in the spot market, and then actual real considerable volumes and funds flowing into that trust, into the ETFs, which are then buying the trust, will potentially create some absolutely enormous moves in the spot price. And that's kind of the setup that we're seeing right now. So getting back to Sprott, they closed yesterday at a 2.2% premium to NAV. However, today they've traded down with the actual spot price rising. So they're certainly below that 1% premium. Perhaps early trading, they were able to raise a bit of cash, but likely not much. We'll have to see if they do any more buying today, as they were sitting on 60.7 million in cash. Seeing the spot price move up a bit, it's possible they were dipping their toe in that market again. So they have raised now over 1.2 billion since August of last year. Their NAV, their total NAV now, their net asset value is at just a hair under $2 billion, 1.98 billion. Now we're approaching valuations in NAV for this trust, of their physical trust for physical silver and gold, platinum, palladium. Those trusts are in the 3-4 billion range. I believe possibly even the gold trust is a bit higher than that. But this has been a fantastic product for Sprott, and they're going to continue to push this thing. They're likely pulling their foot off the gas a bit here, considering the New York Stock Exchange listing application, which is currently in process. However, I think we can see the writing on the wall and see which way the wind is blowing here. When they took over UPC last July, Uranium Participation Corporation, NAV was at 600 million, and now it's just under 2 billion. Of course, that's the appreciation of the spot price in addition to the capital that they've raised. So yeah, we've talked for about a month now about the inclusion of SPUT in the URA ETF, and we expected somewhere between a 7 and 10% allocation. The last market minute I did on Monday, it looked like that allocation was somewhere in the 6+% range, 6.2, 6.3%. Other total holdings, well, now it's sitting at over 11% of the holdings of URA. We believe that it had a cap of 10%. And it's possible that they'll have to sell some down to get back under that limit, or perhaps they amended that limit. We don't really know. Honestly, the way that this particular vehicle URA operates with these rebalances is pretty sloppy, in my opinion. But either way, anything approaching 11%, or even if they near that cap of 10% of the holding of URA, is huge. That's absolutely huge to have SPUT as a substantial holding in both of the two large ETFs in the space, URA and URNM. North Shore Global Uranium Miners ETF, which will shortly be the Sprott Uranium Miners ETF in a couple of weeks. So very good sign to see such a large holding of SPUT in URA. We'll see if they sell that back down to get under that 10% limit. Either way, that's on the upper end of what we were expecting. We are very, very pleased to see that. Even though it meant a number of our other holdings got sold down in the rebalance, that's short-term pain for a long-term benefit for the sector in terms of investing flows going into SPUT. Turning to the ETFs, both ETFs have shown share issuance for the past 3 days. URA issued 910,000 new shares in the past 3 days. URNM issued 100,000 new shares in the past 3 days. These inflows have given rise to 21 million in mandated buying over the last 3 days. Why is URA issuing more shares? Our opinion, URA has a much more liquid and a much deeper options market. When the market makers sell call options, for example, they can't be net short, so they buy the underlying common stock. That puts some buying pressure on the stock. So when you have a lot of call option volume going into a particular vehicle, the market makers are also buying the common, and it has this flywheel effect, sort of kind of it snowballs. Either way, a lot of share issuance. Now we are currently at an all-time high in outstanding shares for these two ETFs, and we're still about 35% down from those November highs. Absolutely fascinating. Nice to see inflows come into the ETFs. Let's see. Yeah, so we obviously were expecting redemptions over the past few months, and we saw the exact opposite. So that's in our opinion a really good sign. Since the first of the year, URA outstanding shares have increased by 4.65 million, URNM by 750,000 shares. So that's almost 140 million in mandated buying since the beginning of 2022 for the two ETFs. Now that obviously actually offset a lot of the selling that they had to do. The combined AUMs of the two ETFs now sit at just under 2 billion, 1.975 billion. Trading action. Well, Wednesday, things lit up quite a bit after the Cameco call. Clearly, the market liked what they heard from Cameco. These conference calls that happen every quarter for Cameco is kind of a prime event for the sector. And all of the sector is always listening to the language coming from Tim Gitzel and Grant Isaac far more than they are paying attention to the actual earnings numbers. Cameco did increase their dividend, which is a good sign. And of course, they announced the restart of McArthur. But before we talk about that in more detail, let's go ahead and take a look at the charts and see what the sector is doing today. I'm actually going to start this chart section of today's podcast by looking at the S&P 500, SPY. S&P 500 is down on big volume, almost 2% on the day. That's a very, very large down move for this massive trust. Why is it moving like this? Two reasons. One, on yesterday, that was Thursday, the CPI inflation numbers came out 7.5%, which was greater than the market was expecting. That caused some weakness in the market yesterday. However, the uranium, most of the stocks in the uranium space were green yesterday during a significant down day in the market. Now today, there's more concern in the markets about impending conflict with Russia over Ukraine. I'm not going to speculate on this at this time. Clearly, there are implications for the markets. Russia is a significant supplier of SWU, as enrichment, for the American markets, for global uranium markets. But obviously, America being the largest producer of nuclear energy, they do get a significant amount of uranium enrichment, in particular, from Russia. So if we end up seeing sanctions on Russia for these products, then obviously that would have huge implications for the uranium market. I think it's far, far too early to speculate on that. We obviously are not trading around what we feel could or couldn't happen with this particular situation, but the broad market clearly does not like the prospect of potential conflict. Like I said, I'm not going to speculate on this. The reason I'm showing you this is because I want to highlight something. That is the relative outperformance. Far less beta than we were seeing even 2 weeks ago. URA down 1.3% on relatively small volume. Most of the stocks in the space were holding up throughout the day relative to a weak broad market, but then we started to see some further news come out regarding this intensifying situation in Ukraine over Russia. And the broad markets got hit even more. And so most of the stocks, generally speaking, are also getting hit. However, this type of day, a 2% down day in the S&P 2 or 3 weeks ago meant a 5% down day in uranium. And now we're actually seeing a relative outperformance. Why is that? Well, in our opinion, it's because sentiment has shifted. That sentiment has shifted due to the verbiage and the language and the guidance that has come out of Cameco from the conference call. And again, I'll speak on that in just a minute. Either way, looking at the technicals for this, RSI now in positive territory, barely actually sitting right on the 50 line. MACD moving up, which is good. It did hold this upward trend line pretty well. However, it's still trading underneath a 200-day moving average, which is moving up barely. We do have this bearish cross of the 50-day below the 200-day, as I mentioned to you earlier in the week, or potentially last week. I don't recall exactly. That bearish cross I give far more weight to when the 200-day is moving down. And of course, the golden cross, the bullish cross, the 50 crossing above the 200-day always has far more weight when the 200-day is moving up. So in this case, obviously, it's not a bullish sign, but it's not really that big of a deal. I would like to see this get back up above that rising 200-day. And I would consider that a resumption of the bull market. I am happy to see this trend line hold. However, we are not even close to being out of the woods in terms of the technical damage that we've seen over the past 2.5 months. Sprott Physical Uranium Trust, like I mentioned, trading down a bit over 1% here today, negligible volume. And considering that the spot price of uranium moved up, we're not trading at a sufficient premium to NAV here for them to issue more shares. and raise some cash. So we'll see if they did anything today in the market with that cash, that 60+ million that they're sitting on coming into today's trading. So mailbag section, I'm actually just going to address a number of kind of broad questions that came to me around asking about my interpretation of the conference call, Cameco's conference call on Wednesday morning. Like I said just a minute ago, this is a kind of a watershed event every quarter for the entire sector to follow. And the sector always listens to what they have to say far more than the actual numbers that they report for their earnings. So what did they have to say? First and foremost, Cameco will be restarting McArthur River. And we did expect that to happen this year. I honestly did not expect them to announce it officially in this conference call. However, I did not trade around this event, nor did I recommend trading around this event. This is something, you've heard me say over and over that we are long-term holders in this sector, and all of our positions, with the exception of the options trades, we consider to be long-term holds. We add on weakness when we can. Of course, we trade in and out of some of these companies when the fundamentals change for the company. But with all of that said, we don't trade around these earnings events, okay? So starting McArthur River, Key Lake, they're projecting full year production at 15 million pounds a year starting in 2024. Why 15 million pounds when we know that they can do 18 million pounds than they have in the past? In fact, the mill is actually licensed to do 24 million pounds a year. So why are they saying 15 million pounds? Well, they still do have Cigar up and running, okay? And Cigar is producing 18 million pounds a year currently. We believe that they're going reduced capacity for McArthur, and they actually announced they're going to be reducing capacity at Cigar down to 15 million pounds as well. Why? Well, it's possible that that's kind of the number where they can get the most pounds out of the mine most efficiently, okay? So while technically they could go all out and produce 18 to 24 million from this mine, they're pulling back because that might be the high point of their efficiency for these mines. Cameco also has a 70% offtake from McArthur and only a 50% from Cigar. So if they bring McArthur on at a reduced capacity and then reduce the capacity of Cigar, they're actually getting more pounds out of that deal if they were doing full capacity at Cigar. So it makes sense to me that those pounds coming out of McArthur at 70%, those are pounds that are not going to hit the spot market. Now, the other 30% goes to Orano. Orano is a spot market seller, not exclusively, but they do sell some in the spot market. So 30% of 15 million, 4.5 million pounds a year going to Orano. I would argue maybe million and a half of that would hit the spot market. That is negligible. This is not an event that should have investors concerned about supply hitting the spot market. In fact, Cameco absolutely nailed this. Why? This was an announcement that most of the market was expecting. Most investors were expecting the market to react negatively to this announcement. It's been inevitable that this mine comes back online. They've been saying for years that they would not bring it back online until the pounds from McArthur's future production were in a safe home, at least a sufficient number of those pounds to justify the costs and the risks of restarting that mine, okay? So what did they also announce along the lines or in conjunction with the announcement of the restart of McArthur? They announced that they have 70 million pounds been added to their long-term contract book since the beginning of last year. 70 million pounds, okay? The clincher with this, 40 million of that 70 million was added in the first 5 weeks of the year. All right. These are big numbers, okay? And why did the market react so positively to this? This is new supply coming into the market in a year or two. Why is the market celebrating this? Because one of the primary thesis points of being long uranium equities for years has been the expectation of a resumption of a bona fide long-term contracting cycle. These long-term contracting cycles happen in cycles because of the dynamics of oversupply, undersupply, the slow rotation, the slow response for uranium in particular to higher prices, et cetera. And what you have is a situation where perceived reduction in supply that was during the previous bull market, right? You had Cigar Lake mine flood, McArthur mine flood, Chinese, stating that they're going all out nuclear. And you had this perception of a supply shock. And so you had one utility after the other jumping into the term market. And one CEO that I speak with on a relative frequent basis says that utilities somewhat tend to act like herd animals. So there are obviously a number of very, very sharp fuel buyers. And actually, I would argue that most of them are extremely sharp and on top of this market. They understand what's going on in this market. However, in order to take the risk of going into the term market and securing pounds at prices that are rising, you have to kind of have to go along with the consensus, and the consensus could be starting that this market is about to be extremely thin and it's time to start securing pounds. Okay, so that's the signal. And all investors in the space who have been following this for a number of years have been expecting eventually we would see a bona fide term contracting market. Now, it doesn't mean that utilities, generally speaking, aren't always signing term contracts. They are. Term contracts are the primary way that utilities secure fuel. Primary. The spot market is, I would say, behind term contracts would be carry trades, which usually are for a shorter time frame, like a midterm carry trade. And beyond that is buying in the spot market. And buying, you can buy all the elements of the fuel cycle in the spot market, not just U3, like buy UF6 in the spot market. You can buy spot SWU, which is enrichment. And so, but to see 40 million pounds contract in the first 5 weeks of the year is a really big number. And that's what the market is reacting to. So I was speaking with a fuel buyer friend recently. His reaction to those numbers they were eye popping. That was his actual words, right? Excuse me. And so what we have currently is a market that not only is recognizing the impact of financial flows into the uranium market and what we've seen that's been able to do, okay, especially when the volumes are really great, like last August, September, right? That was proof of concept for the spot flows, okay? And the market knows that spot is here and that this is happening, okay? Albeit a little bit slower now, but you know my thesis on that. Now we have this second element coming in that's okay. Term contracts could be starting now. This is the classic fundamental positive movement for the uranium market is the term contracting cycle taking up. So what we've had is quite a few years in the past 5-6 years where term contracting has been at a lower volume than the burn rate for the reactors. Okay, so we had many years where it was higher, where we had that was the previous bull market going into the early part of the previous decade, where we had term contracts in the 200-300 million pounds a year, drop down to a couple of years where we had less than 100 million pounds a year of term contracts signed. And so Cameco now saying they signed more pounds into term contracts in the first 5 weeks of this year than they did all of 2021. That's a major signal to the market. That's why you're seeing the market react this way. That's why, in my opinion, we're seeing a bit more positive sentiment, and we're seeing some outperformance in the uranium market to the broad market, which is backwards from what we experienced just 2-3 weeks ago. So these are all really good signs. So yeah, during the conference call, we heard phrases like contracting begets contracting, right? Like I just mentioned, kind of the herd animal thing is utilities, generally speaking, will start to perk up if some of the smaller utilities hear that Duke or Exelon have gone in and signed a big contract with Cameco for 2027 to 2032 at X price, then that will wake them up and say, oh, there's something here and we need to follow suit. In reference to whether or not the tide has turned, Cameco CEO Tim Gitzel stated, "Today is the day," and he said it with a lot of conviction. And that was, I mean, I've been critical of Cameco in the past in terms of their conference calls. I think there's no shortage of examples of previous conference calls where they just totally put their foot in their mouth and killed whatever rally was happening in the market. And so now, they have a difficult job. They have to balance what's best for the company in terms of cash flow. They have to make sure that they have pounds to fulfill their contracts. And they also have to take care of the shareholders. It's not one or the other. They have to do both. And it's very difficult to do both. And they absolutely nailed both in this conference call by announcing the restart of this mine, which will be positive for the company, and also announcing the reasoning for the restart. Massive term contracts coming to Cameco. Really good sign for the market, good sign for the company. And they, of course, reiterated that they have homes for these pounds. They have a lot of production out in let's say the later half of McArthur River's production, a number of years down the road that do not yet have term contract homes, but they fully expect to. And this is a big sign, right, that we're seeing these term contracts come in this sort of volume early this year. So this, in my opinion, this portends a potentially very strong year for the sector. I think that's all I really have to say about that. So it's very good to see not only the market react to that conference call, and for that cat to finally be out of the bag. This is something that the sector has largely been fearful of, that the announcement of, another 15, 18 million pounds coming online, even if it's 2 years down the road, right? So they said they could see as much as 5 million pounds produced this year from McArthur. However, that's largely from tails material that's being held in the mine. We'll probably see somewhere around the same amount for 2023, around 5 million, and then full production in 2024. So this is not going to lead to a shock and some supply into the spot market. It's just not. So this is a very, very positive sign. I'm very pleased to see it and to see the market react to it. I do believe that there's a lot of very, very sharp investors that are very aware of this thesis. And I think that's only going to continue, especially when the flows continue with a number of the catalysts we mentioned in previous episodes. All right, I'm going to leave you guys with that. I hope you all have a great weekend. I will see you on Monday, which is Valentine's Day here in the States. And hopefully my wife will allow me to get out of the house and go to the office for an hour. But yeah, either way, have a great weekend. And I'm very pleased to see the market action this week. I hope you are as well. Hope everything is well with you. And we'll see you next week. Cheers.